Hello, everyone, and welcome back to the Financial Freedom Show. If you're new here, I like to dive into the world of investing, ETFs, and building long-term wealth. Today, we're going to talk about a very unique ETF that's been getting a lot of attention lately, the QDTE Roundhill 100 0 Days Till Expiration Covered Call Strategy ETF. This ETF is unlike many out there, with a cutting-edge strategy, higher expense ratio, and something that'll catch the attention of many income-focused investors, a weekly dividend payout. So if you're interested in learning more about how this ETF works or whether it deserves a spot in your portfolio, stick around. Without further ado, let's get into today's video. So let's start with the basics. What exactly is QDTE ETF? QDTE stands for the Roundhill 100 0 Days Till Expiration Covered Call Strategy ETF. And it's one of the first ETFs to utilize a 0 days till expiration covered call strategy. This means that the ETF is writing covered calls that expire on the same day that they are initiated. These option strategies are designed to generate income through options premiums while holding a diversified portfolio of the 100 largest U.S. stocks. Covered call strategies are a popular way to generate income from a stock portfolio. In this strategy, the ETF sells call options against stocks that it already owns. If the option is not exercised, the ETF keeps the premium and the underlying stock. If the option is exercised, the ETF sells the stock at the strike price, potentially capping the upside, but also collecting the premium. The 0 days till expiration aspect of QDTE is what makes it particularly interesting. By writing calls that expire on the same day, QDTE aims to capture the options premium without the risk of holding the option overnight. This approach can generate significant income, especially in volatile markets, but it also requires precise execution and comes with its own set of risks. One of the standout features of QDTE is its income potential, particularly for income-focused investors. Unlike most ETFs that pay dividends quarterly, QDTE pays a weekly dividend. Yes, you heard that right, weekly dividend payout. This makes it an attractive option for those who want regular income to stream out of their investments. These weekly dividends come from the options premiums generated by the ETF's covered call strategy. The more volatile the market, the higher the premiums, which can lead to higher dividend payouts. However, it's important to note that their dividend amounts can vary from week to week, depending on market conditions and the ETF's performance. This weekly income feature has a double-edged sword. While it provides regular cash flow, the variability means that you might not always know exactly how much income you'll receive. But for investors who value frequent payouts that are willing to accept some variability, QDTE could be a definite game changer. Now let's focus on the cost of investing in QDTE. One of the first things you'll notice is that QDTE has an expense ratio of 0.95%. That's definitely on the high side compared to more traditional ETFs, but it's important to understand why. The expense ratio reflects the complex strategy behind QDTE. Managing a 0 days till expiration covered call strategy requires more sophisticated trading, active management, and precise execution. The costs associated with this strategy are higher, and that's passed on to investors in the form of a higher expense ratio. While 0.95% is higher than what you'd see in more passive ETFs, the income potential for higher income and unique exposure may justify the cost for certain investors. However, it's crucial to factor in these costs when considering QDTE as a long-term investment, as higher fees can eat into your returns over time. Of course, no investment is without risk, and QDTE is no exception. While the ETF's exposure offers high income potential, it also comes with higher volatility and certain risks that you need to be aware of. Firstly, the 0 days till expiration strategy means that the ETF is constantly in the market, writing and closing call options every day. This can lead to higher transaction costs, which combined with the expense ratio can impact overall returns. Additionally, if the market experiences a sudden move, the ETF could be forced to sell stocks at a less than ideal price, capping potential upside gains. Another key risk is that while the covered call strategy generates income, it also limits upside potential. If the underlying stocks in the ETF experience significant gains, those gains could be capped if the options are exercised. This means that you might miss out on some of the upside in a strong bull market. Lastly, the income generated from the covered calls and the resulting dividends are not guaranteed. Market conditions, volatility, and stock performance all play a role in determining how much income this ETF can generate. So it's essential to be comfortable with the variability of returns when considering QDTE. So who is QDTE best suited for? This ETF could be a great fit for investors who are looking for a high income strategy with frequent payouts. If you're an income-focused investor who's comfortable with the risks associated with the covered call strategy, and you're seeking regular weekly dividends, QDTE might be worth a closer look. However, QDTE is not for everyone. If you're looking for capital appreciation or you're a more conservative investor, the risks and higher costs associated with this ETF might not align with your investment goals. It's essential to weigh the potential income against the risks and costs to determine if QDTE is the right investment for your portfolio. QDTE might be particularly attractive for those who want to diversify their income sources, particularly in a low interest rate environment where traditional income investments like bonds might not be providing enough yield. But as always, make sure to do your own research and consider your financial situation and risk tolerance before making any investment decisions. QDTE might be better to put in a Roth IRA or a tax-advantaged account. That way you don't have to pay the income tax that you get whenever the weekly dividend payments come through. Just because those weekly dividend payments are considered regular income, you're taxed at a regular income rate. So that's another thing to consider when investing in QDTE. You want to do it in a tax-advantaged account so that you don't have to pay taxes on those gains. In conclusion, the QDTE Roundhill 100 0 days till expiration covered call strategy ETF is a unique and innovative approach to generating income in today's market. With its weekly dividend payouts and cutting-edge strategy, it offers an intriguing option for income-focused investors. But with higher costs and risks, it's not a one-size-fits-all solution. If you're considering adding QDTE to your portfolio, make sure that you understand how the strategy works, the associated risks, and whether it aligns with your financial goals. Thank you for watching. If you found this video helpful, please be sure to give it a thumbs up and don't forget to subscribe to the channel for more insights on ETFs, investment strategies, and building wealth. Drop a comment down below if you have any questions about QDTE or if you're putting it in your portfolio or any other topics that you'd like me to cover. I'd love to hear from you. See you in the next video.